Florida's condo dream is collapsing. Not cooling, collapsing. Prices haven't dipped by 5% or 10%. They've fallen off a cliff, down 25%, 30%, even 32% in cities that seemed untouchable just 2 years ago. Families who bought at the peak are trapped underwater, watching their savings disappear. Retirees are being crushed by soaring insurance costs, massive special assessments, and a harsh new truth: no one's buying. Inventory is overflowing. HOA fees are exploding. And the cost of simply keeping a roof over your head has never been higher. What was once the Florida dream has turned into a full-blown financial storm. Today we're counting down the top 10 Florida cities where the condo market is crashing in 2025. Stay tuned until number 1. And if you want more unfiltered housing reality, hit subscribe now, and let's dive in. Number 10. Sarasota. Once the crown jewel of Florida's Gulf Coast, Sarasota sold a vision of perfection: white sand beaches, a vibrant art scene, and gleaming towers along the bay. But that glossy picture is cracking fast. Condos that fetched $600,000 in 2022 now struggle to sell for $420,000, a stunning 30% collapse. Inventory has jumped 65% year over year, flooding the market as sellers slash prices just to survive. The real pain lies in the costs. Insurance premiums that once ran $3,000 now exceed $9,000. HOA dues and reserve mandates have pushed monthly ownership above $1,200 before the mortgage. Buyers are terrified of surprise assessments: $20,000, $30,000, even $50,000 per unit. Retirees on fixed incomes can't keep up, and investors are fleeing. Rental yields that once hit 7% have dropped below 3%. Developers are quietly offering steep behind-the-scenes discounts just to move inventory that used to sell before construction even began. Lenders are tightening standards, demanding huge down payments or refusing loans on older buildings altogether. Sarasota isn't just cooling, it's recalibrating to reality. A harsh warning for every coastal Florida market that thought prices could only rise. Number 9. Ocala. Known for its horse farms and quiet charm, Ocala was never supposed to crash, but it has. Condo prices that peaked at $220,000 have dropped to $160,000, a 27% freefall. Inventory has surged 62%, and buyers have vanished with mortgage rates near 7%. Even modest condos cost $1,300 a month before utilities, unaffordable for households earning under $60,000. New reserve laws, repair mandates, and insurance premiums that jumped from $1,800 to $5,000 a year are crushing owners. Special assessments of $10,000 or more are common. Small investors who bought with pandemic savings are watching their properties bleed cash. HOA boards, often run by volunteers, are overwhelmed by angry owners, maintenance deadlines, and ballooning bills. Some condos have already seen owners walk away, leaving others to cover the shortfall. It's a buyer's market, but only for those with deep pockets. Number 8. Cape Coral. Once the poster child of Florida's pandemic boom, Cape Coral's paradise is unraveling. Median condo prices have fallen from $340,000 to $240,000, a brutal 30% wipeout. Inventory is up 95%. Waterfront insurance exploded from $3,500 in 2020 to over $10,000 now. HOAs of $600 to $900 a month, plus special assessments of $20,000 to $30,000 for flood protection, have made ownership unbearable. Airbnb owners are losing money with occupancy under 45% and revenue down nearly half. Post-Hurricane Ian, new FEMA flood maps have scared off buyers entirely. Canals are lined with for sale signs that don't move. Developers face half-finished projects, contractors are slowing, and insurance firms are withdrawing from high-risk zones, forcing owners into expensive state-backed plans. Cape Coral has become a case study in overexposure, where climate risk, cost inflation, and speculation collided head-on. Number 7. Bradenton. Just north of Sarasota, Bradenton's condo market is in full retreat. Prices have fallen from nearly $400,000 to under $280,000, a 30% plunge. Inventory is up 70%, with over 1,500 listings clogging the MLS. The culprit: affordability blown apart. HOA dues now run $500 to $900 a month. Insurance that once cost $2,800 is now $7,000. At a 7% mortgage rate, total monthly costs exceed $2,200. Renting is cheaper than owning, and investors know it. Airbnb profits have crashed, occupancy below 55%, nightly rates down 20%. Pre-construction buyers are walking away from deposits rather than closing on overpriced units. Developers who broke ground in 2021 face grim math: higher construction loan rates, unsold units, and fading demand. Even longtime locals say it feels like 2008 deja vu, except this time it's not bad lending. It's cost of living inflation devouring the dream from the inside out. Number 6. Orlando. The land of Disney dreams is now facing a condo nightmare. Prices that once soared to $310,000 have fallen to $230,000, down 25%. Over 3,500 condos sit unsold, nearly double last year's listings. HOA fees of $600 to $1,000 and doubled insurance premiums mean a two-bedroom that cost $1,800 a month now exceeds $2,600. The Airbnb gold rush. Oversaturated disaster. Occupancy hovers near 50% and nightly rates are falling. Add Florida's new structural inspection laws, $10,000 to $20,000 assessments per unit, and lenders are backing out. Even cash buyers want steep discounts. Streets that sold out in weeks in 2021 are now lined with for sale signs. Developers are halting projects, waiting for costs and insurance to stabilize. Tourism doesn't make you immune. When affordability breaks, even the happiest place on earth can't escape the math. Number 5. Jacksonville. Even Florida's biggest city isn't immune. Median condo prices dropped from $230,000 to $180,000, down 22%. Inventory has surged 60%. HOA dues of $400, insurance at $4,000, and some mortgage push monthly costs to $1,700, while renting averages $1,400. The math kills demand. Out-of-state investors are dumping units, and 35% of listings now show price cuts. Downtown revitalization projects that once symbolized growth now offer incentives just to fill empty units. Lenders are skittish on older buildings under Florida's stricter rules. For years, Jacksonville was seen as steady, safe from volatility, but buyers from 2021 with 3% mortgages now face 40% higher payments. Many are stuck in negative equity. Optimism has turned to anxiety, and the number one buyer question is, what's the insurance? Number 4. Aventura. Once Miami's glittering suburban escape, Aventura is now the perfect example of luxury meeting limits. Condo prices that peaked near $600,000 in 2022 have fallen to $440,000, a 27% drop. Inventory is up 80%. Insurance premiums in coastal Broward and northern Miami-Dade have tripled since 2020, exceeding $12,000 a year in many towers. HOA fees top $1,200 a month, and new state reserve laws are forcing $25,000 to $60,000 special assessments per unit. Those sleek towers along Biscayne Bay, once marketed as low-risk havens, are now financial minefields. International buyers from New York, Venezuela, and Brazil are retreating as carrying costs exceed rental income. Short-term investors are pulling back as occupancy dips and restrictions tighten. Developers are quietly cutting prices and offering incentives just to move units. Confidence has evaporated, replaced by hesitation. Even luxury cracks when the math breaks. Number 3. Tampa. Tampa's skyline once stood for unstoppable growth. Not anymore. Median condo prices have dropped from $310,000 to $230,000, down 25%. Bayshore high-rises that sold for $600,000 now sit unsold at $400,000. Inventory is up 85%, reaching 4,000 active listings, the highest since the Great Recession. HOA fees that were $450 now hit $1,000. Insurance near the Bay tripled to $9,500. Monthly ownership now exceeds $2,400, impossible in a city with a $70,000 median income. Short-term rentals are cracking, occupancy below 50%, rates down 20%, and 40% of listings showing price cuts. Developers are dangling closing credits, furniture packages, even a year of HOA coverage, but confidence has cracked. Resilience costs money, and that money is running out. Number 2. West Palm Beach. Luxury has limits, and West Palm Beach has hit them. Median condo prices that topped $400,000 in 2022 are now $300,000, a 20% drop. Insurance premiums have tripled to $12,000 a year. HOA fees have doubled to $1,000 a month. Surprise assessments of $30,000 to $40,000 are driving retirees to walk away. Airbnb occupancy is below 50%, nightly rates are down 15%, and lenders are refusing to finance aging towers. 2 years ago, West Palm was called the new Miami. Today, open houses are empty, sellers slash prices weekly, and buyers are waiting for the bottom. High-end buyers are negotiating 20% below asking and getting it. International money is fleeing north to newer, better insured developments. Prestige isn't gone, but balance is. Number 1, Pensacola. At the top of the list and the bottom of the market is Pensacola. Once celebrated as an affordable coastal gem, it's now ground zero in Florida's condo collapse. Prices that peaked at $310,000 in 2022 have crashed to $215,000, a 31% nosedive that's wiped out years of equity. Inventory is up 90%, flooding the market with listings no one wants. Sellers chop tens of thousands off prices, but buyers are gone. HOA fees that were $400 now reach $800, and insurance premiums for waterfront units have tripled to $7,000. Add 7% mortgage rates, and monthly costs exceed $2,200 in a city where the median income is $60,000. Investors have fled. Airbnb occupancy is under 50%. Long-term rents don't cover expenses. Lenders are blacklisting older complexes, so only cash buyers remain, and they're bargain hunting. Pensacola's collapse is especially painful because it represented the middle-class dream: affordable, stable, attainable. But that dream cracked under insurance chaos, rising fees, and investor flight. The sun still shines on Pensacola Bay, but beneath that calm surface lies a market in freefall. Florida's condo market isn't in correction, it's in reckoning. And Florida isn't alone. Texas, the real estate giant of the South, is showing cracks in 2025. Median home prices across the state are down about 3.2% year over year, now averaging around $331,000, more than $70,000 below the U.S. median. Austin leads the declines at down 6.4%, followed by Dallas at down 4.1%, San Antonio at down 3.5%, and Houston at down 2.8%. Inventory has surged 30.7%, with more than 132,000 active listings, and homes now take about 105 days to close, up from last year. This is a major shift from the surge between 2020 and 2022, when low taxes, cheap land, and corporate relocations drew hundreds of thousands of new residents. During that boom, listings vanished overnight and prices skyrocketed. By 2024, supply doubled, erasing seller dominance. With mortgage rates hovering between 6.8% and 7.2%, affordability became the new ceiling and demand slowed sharply. The psychology flipped. In 2021, buyers feared missing out. In 2025, they fear overpaying. Bidding wars disappeared, replaced by seller concessions, covering closing costs, buying down rates, tossing in incentives. Yet this isn't a crash. Texas didn't overbuild like in 2008, and population growth remains strong. What's happening now is a recalibration, a repricing of risk. Affordability is the heart of it. A $330,000 home at 3% interest cost roughly $1,400 a month in 2021. In 2025, at 7%, that same home is over $2,600 before insurance or taxes. Middle-class buyers are getting priced out. Sellers cut prices or wait months for offers. Inventory is higher, but sales are down about 1.5% statewide. Insurance premiums add pressure. Across Texas, especially in Houston and along the Gulf, rates have jumped 20% to 40% as carriers react to billion-dollar storm losses and wildfire risks. For many buyers, insurance adds $200 to $300 to monthly payments, wiping out affordability gains. Lenders require larger escrow reserves, delaying closings that already take more than 100 days. Insurers are pulling back coverage in flood-prone zones, and even minor FEMA map updates can freeze entire neighborhoods overnight. Liquidity is drying up. Fewer deals close, and those that do take longer. Median days on market, about 105. Total listings, nearly 133,000, up 30.7% from a year ago. Homes still sell, but more slowly, and only after price cuts or negotiation. Realtors call it a pause market. Transactions happen, but at a crawl. Sometimes the slowdown hits instantly. A Fed statement hinting at delayed rate cuts can stall deals statewide within hours. Coastal insurance moratoriums after storm warnings have the same effect. These micro-freezes stop the market for days at a time, creating uneven momentum. Buyers are watching interest rate news like weather reports. As one agent put it, "We're not waiting for prices to drop anymore, we're waiting for rates to breathe." Meanwhile, Texas's growth model is straining. The no-income tax policy attracts residents but limits funding for infrastructure and housing programs. Local governments struggle with zoning backlogs, staffing shortages and rising construction costs. Developers in Austin and Dallas complain about doubled permit times. Houston grapples with flood regulations and inspection bottlenecks. The result is a tangle of delays that reinforces the market's sluggish feel. And it's not one story, it's several. Austin hit hardest, is down 6.4% as tech layoffs and luxury overbuilding drag prices. Dallas-Fort Worth is mixed, some suburbs down 4%, others slightly up thanks to corporate relocations. San Antonio fell about 3.5% as insurance and taxes offset its affordability. Houston remains relatively stable, supported by oil jobs but pressured by insurance costs. Smaller cities like Waco, Tyler and College Station are bucking the trend, with modest growth driven by remote workers and retirees chasing value. This is the pattern of 2025. Woolworths 24. Texas isn't collapsing, it's redistributing. Wealth and demand are shifting outward, away from overheated metros toward balanced mid-sized markets. The frenzy of 2021 has given way to a cautious equilibrium, where patience and negotiation rule. By late 2025, analysts project prices to stay flat or dip slightly before rebounding in mid-2026, assuming rates ease. The fundamentals, jobs, population growth, pro-business climate are intact. The scoreboard median price around $331,000, inventory up 30.7%, home selling in 105 days, sales down just 1.5%. For buyers, this is the moment to prep financing and be selective. For investors, it's a sniper market, targeted patient discipline. And for homeowners, it's a reminder the market didn't crash, it normalized. The boom cooled, the market is breathing again and the path forward is slower, steadier and built to last. If you found this breakdown useful, hit subscribe, drop a comment with your city, and tell me what you're seeing on the ground. The data's real, but your stories bring it to life.